So I want first to thank IPEA and the BRICS Policy Center and the T20 for inviting all of us to be part of this webinar. I'm really looking forward to it because international taxation is really one of the centers of the Brazilian G20 presidency, is one of our key priorities. So now in the next week or so, we'll be hearing a lot about soft landing. This is the language that international organizations, the IMF, is using a lot to talk about the global economy. And indeed, if you look at the macroeconomic data, we are heading towards a more benign macroeconomic scenario with inflation's going down, converging to the different targets of different central banks, and growth still resilient, and labor markets still resilient. And this is all very good news. But then if you look at the social aspect of the macroeconomic data, then we start seeing very worrying trends. So inequality is rising. We are going further and further away from the SDGs. SDG 1 and 2 seem to be almost unreachable. We think we still have to put an effort to try and achieve SDGs 1 and 2, and the Brazilian G20 presidency is very committed to achieve that. But there's no sugarcoating here. The situation is very challenging from a social perspective. And here, international taxation plays a very important role, because it's a key tool that we have to address inequalities and channel resources to achieve SDGs 1 and 2. And one of the key topics of the Brazilian G20 presidency is exactly that. It's really revamping the international taxation agenda. It is an agenda that has produced quite a lot in the last 10 years. We have very encouraging negotiations for BEPS Pillars 1 and 2. We have already achieved quite a lot there. But I think there's a consensus forming that that's not enough. And there's also another front of negotiations in the UN, the Framework Convention for International Taxation in the UN is also a very positive outcome. Since the end of last year, we have countries negotiating, talking about the terms of this convention, and this is very good news. But we have a sense of urgency, right? So how do we square that circle? How can we accelerate progress towards international taxation to direct resources to SDGs 1 and 2, and how we can use that as a tool to address inequalities. So the title of our panel today is The Taxation of Global Wealth, New Perspectives. And I think the taxation of wealth is really a topic that has been opened in the last few years. There has been a lot of new analytical input, and civil society has been putting a lot of pressure for government and international organizations to talk about this topic. So we are very keen to hear more and to learn about ways to tax wealth, ways of thinking of taxation connected to wealth. We have different proposals on the table, and it is really exciting to see a panel with such great specialists here that can really enlighten us on the topic. So let me introduce the panel. The panel today has Alexander Clem, who is the Chief of Division at the IMF, at the Fiscal Affairs Department, and he holds a PhD from the UCL and has authored several papers and analytical input on the matter. We have José Troya, who is in his second term as a member of the UN Committee of Experts on International Cooperation in Tax Matters, and has also worked with tax in the Equatorial tax authorities for several years and has very valuable experience to share. We have Sarah Parrott, who is the head of the Personal and Property Tax Unit in the Tax Policy and Statistics Division of the OECD Center for Tax Policy, and also has authored many papers and analytical input on the matter. And then we have two people from the Brazilian government and civil society to comment on the panel. The first one is Daniel Loria, who is director of the Brazil Secretariat on Tax Reform, and they're doing amazing work there on tax reform in Brazil. So thank you very much, Daniel, for finding time to join us and comment on this panel. We have Nathalie Begin, who is the leadership in civil society and has been a great partner to push the agenda in international taxation. Thank you, Nathalie, for joining us and commenting on this panel. Each panelist will have about 15 minutes, and then we have our two debaters commenting for about 10 minutes. Then we will open for questions. So if you have questions, please write your questions in the Q&A. and I will be happy to read them at the end of the session. The panel should last more or less 2 hours. We are aiming to have 1 hour and 15 minutes of presentations and comments, and then about 40 minutes, 45 minutes for Q&A. So I will leave it here. You heard enough from me. I am Felipe Antunes de Oliveira. I'm a senior lecturer in international relations at Queen Mary University of London, and I'm also serving as the Coordinator General for International Economic Cooperation in the Brazilian government. And here I'm helping in the G20 agenda, specifically in the G20 agenda on taxation. I may have also some comments at the end of the panel, and I will update you on what is next for the Brazilian G20 agenda at the end of the panel. But first, I think we can start hearing from Alexander. So Alexander, please, the floor is yours. Thank you so much for joining us.
Thank you very much for this introduction, Felipe. Good morning, everybody. It's a pleasure to be here. Thanks a lot for the invitation. Let me share my screen and show you my presentation. And I hope you can see it. So I have now a relatively short time to discuss this really interesting topic on how to tax wealth domestically, internationally, returns, stocks. There are so many questions that this raises. Let me see. So just as a very, very brief reminder to get a little bit into the mood, I have a couple of slides here that really show you how wealth inequality is much worse than labor inequality. So if we only look at labor income, we are kind of missing a lot of the picture. Given my short time, I'm not going to discuss the complicated left side picture, but if you want to, you can think about it. The right-hand side picture is much easier to understand. It just shows you the labor share of income in GDP. And that has been declining over the decades. It's not a steady process, but it is a clear downward trend. And at the same time, we know that the taxes that we are raising on capital, they have been declining. And it doesn't matter if you look at the corporate side. So on this slide, we're looking at the corporate side. The corporate income tax has come down. Everybody knows this picture, at least everybody who is interested in taxes. But the same is true at the personal side. So on this picture, you see tax rates on interest, on dividends, and so on. And all of those have come down too. So overall, the taxation of capital has declined over the decades. And that's a problem because tax policy is the key tool you have, among the peaceful tools at least, to address wealth inequality. So if you care about poverty, you can presumably do it through spending policy as well. But if you care about inequality at the very top, right, how much does the top 1% earn compared to the top 0.1%, you're not going to help them by providing them with free schooling or something. You can only do it through the tax system. There are some other policies you can do. So if the rich get rich because of anti-competitive behavior, you can improve your competition policy. You can fight corruption and deal with these things. But you can't address everything that way. And especially some of the inequalities, the result of favorable developments. So there are technological advances, there's international trade. We would not want to stop these things. That would be a pity. But tax policy can help us address the outcome if the outcome is unequal. So this leads us to the first big question. Should capital be taxed at all? Might seem a silly question, but there are economists who would argue that we should not tax capital because it distorts the savings decisions of individuals, and then you treat people differently depending on when in their lifetime they earn their income. But I would argue that this result has very limited practical applicability. We know that a lot of capital income is not the result of people making life cycle choices, i.e. saving for their retirement. It could be the result of endowments, inheritances. It could be the result of income that was never taxed. And it could be, importantly, the results of economic rents, i.e. incomes that far surpass any normal rate of return. In addition to these practical doubts, there are even some recent theoretical papers that question this result. So I think overall, we could conclude there is a strong case for capital taxation in the world in which we live. This leads us then to the next part. If we want to tax it, how do we want to do it? There are at least 3 ways we can go after the wealth. We can tax it through a capital income tax, meaning that we look at the returns earned on wealth. So this would be interest, dividends, capital gains, and the profits of corporations. We could also go after the stocks. Everybody figures out how wealthy they are, and then there's a wealth tax on that stock. Or we could go after the wealth transfers. So whenever somebody gives away or has a bequest, we can tax it at that. So that raises the question, which is the best way? Or maybe it's a combination of those two. And so some people, they just hear wealth is unequal, and then they jump to the conclusion, well, then we must tax wealth stocks. But here I would argue that it's not so easy. So here, for example, I have compared two people with assets that give different rates of return. So you can see at a rate of return, this is artificial because this is a stylized example. At a rate of return of 5%, I've set a wealth tax that is exactly equivalent to the income tax. If the rate of return of the asset increases beyond that, then clearly the average income tax on the return earned declines, and vice versa. If you have a very low return, then the implied average income on the return rises if you have a wealth tax. So what this ultimately tells us that the wealth tax is actually really favorable for people who earn extremely high rates of return. So people who earn economic rents, either because they know how to do it or they get good advice or something like that. While somebody who just gets an average rate of return would be would be indifferent, and somebody who has a low rate of return would actually be better off with an income tax. So a wealth tax, actually, if the alternative is taxing the capital income, is not particularly equitable, and it's also not efficient, because rents are usually the thing we really want to tax, because you can do this in a non-distortionary way. And the wealth tax effectively leaves the rent or a part of the rent untaxed and just taxes a fixed return. There's a counter argument. I don't have time now to go through it in detail, but we have written a paper where we argue that this counter argument doesn't apply. So in most cases, wealth taxes will be not only more equitable, but also more efficient. There are some other differences between a tax on wealth stocks and returns. So one is liquidity. This argument that, for wealth tax, you have a problem because you don't have liquidity to pay it. Well, this is sometimes exaggerated, this problem. So there are some papers that show that as long as the threshold is reasonably high, really very few liquidity constrained people would be affected. Another issue is that if you have a wealth tax, the tax bill can exceed the income. And if your rate of return on your wealth is low, that's actually very likely to happen. So there is a legal side to this. Some countries may not allow this. But and we'll come back to that later, there's also an interesting other angle to this. And then some people always say we have to have a wealth tax because it's so difficult to value assets to determine capital gains. Now, it's true that it's difficult to value those assets, but wherever it's difficult, it's also going to be difficult to apply a wealth tax, because you also have to value these assets to apply the wealth tax. So if you think of a piece of art or something like that, it is going to be difficult to value, no matter if you want to go after the capital gain or after the stock. Let me now quickly go through a couple of issues that we encounter. So let's say we want to fix the issue by raising more income from the returns on capital. So one issue is that in many countries, capital gains are taxed much more lightly than all other forms of capital income. And this is just an example that shows you that if you have two assets, exactly the same rate of return, but one of them is distributing. One of them, sorry, I'm almost there. This is what I wanted. So one of them is distributing, and the other is just leading to a capital gains. Then you can see that the longer the investment horizon, the more the asset using capital gains benefits compared to the one distributing, because it is taxed only on realization and not on every return like the other asset. So most tax systems in the world have this feature built in. And if you combine this, with the fact that capital gains disproportionately accrue to rich taxpayers, then you can see that this is a major tax advantage that benefits the top of the income distribution. So here I have some data for the US and the UK, but I'm pretty sure that this is the same everywhere. Let me just read out one of them. So in the US, the top 0.01%, so these are really extremely rich people, they earned 60% of their income as capital gains. So in a form that is actually favored by the tax system. In the interest of time, let me skip the dividends and let's jump to issues in taxing wealth. So some people say, well, we already tax wealth, we have a property tax. To that I say, well, property taxes, they are great for many purposes, but they are not wealth taxes because you cannot deduct the debts, the mortgages, or however you do it. So it's not really a measure of wealth. And moreover, and this is the chart here, the richer people are, the smaller the proportion of real estate in their wealth portfolio. It's quite logical for most middle-class families. Their home is their main asset. But once you are much, much richer, you're going to own also lots of other assets. Some countries do tax wealth, but the existing ones, they raise very little revenue. Among OECD countries, also, many of those who raised in the 90s or 80s, they have abolished their wealth taxes because they didn't yield very much. Now, that doesn't mean that the future wealth tax couldn't be designed in a better way, but it certainly shows us that in the past, it has not really worked out well. And I mentioned this before. So if we think about wealth taxes for the super rich, so something with a really high threshold, and some people talk about thresholds of 1 billion or more, or here, at least in this example, it's 50 million or more, then it really is a little bit of a different discussion. We don't need to worry anymore about liquidity because these people are going to be liquid and able to pay taxes. Administrative costs, they are small, at least because there are very few people affected by it. And most people who will never be that wealthy in their lives, they will not be discouraged by such a tax. So then we can see also, and this is what I mentioned before, in such a tax, we could set it in a way that actually it's wealth reducing. I'm not arguing in favor or against this. I'm just pointing out that this is a possible way to do it. But if the aim is to raise revenue, then it's probably not the way forward because there is not much revenue in it, which is quite logical if you have a tax on a very small base. You are not going to receive a lot. So it's mostly a discussion about progressivity at the top and what you can do with it. Finally, and that's a point that is relevant irrespective of whether you go after returns on capital or stocks of capital. If you want to tax a wealth of rich people, administration and enforcement are critical. So there is ample empirical evidence that tax evasion at the top is quite high. So here I've got some numbers from Scandinavia and from the US. Of course, they're all subject to uncertainties because there is no hard data on tax evasion. Let me just quote one of these numbers here. So there are these very recent estimates from 2023 that untaxed offshore hidden wealth is 3% of global GDP. Which again, it's not going to address all the spending needs of the world if we were to tax it, but it's also not negligible. So what is really crucial here in terms of international cooperation is strengthening the already existing processes. So there is this automatic exchange of information from under the Global Forum. So far, the access to these data by developing and some emerging countries is limited. So we have to make sure they all are able to access and use those data. And not all assets are covered. So there are certain assets, I put here real estate as an example, that are not included in automatic exchange of information. So there are still ways for taxpayers to go around it. More sophisticated, even there are these programs for like citizenship by investment and so on that people can use to get around some of these rules. So with that, it was a bit of a rush through the topic here, but let me come to some conclusion. So overall, wealth should be taxed. I think we have overcome this idea that is in some simple economic models of zero rate on capital. This result exists, but it has very limited practical applicability. However, that does not mean we need to have a tax on wealth stocks. So as I have argued here, generally it's more efficient and equitable to go after the capital income rather than after the stocks. And then the only exception is some wealth tax on the super rich, which raises somewhat different issues. And if we want to tax capital income, then there are many ways that we can strengthen the way we do it now. So the tax rates, very often in many countries, they are low compared to those on labor income. So where that is the case, we might bring them up toward. I'm not even saying that they must be equal, but where they are very low, there is room to bring them up. Probably even more important or more urgent is address loopholes. There are many loopholes that allow rich taxpayers to pay much lower tax rates than what is foreseen even under the capital income tax rate. I went a little bit through this example of capital gains. And that is, I think, the key one, but there are other ones. And then we need more use of recent technological data and developments. And that part has a very strong international angle, because unless you cooperate across borders, it's not possible to enforce it. Yeah, and with that, I conclude my presentation and I look forward to the discussion. Thank you.
Thank you so much, Alexander. This was really fascinating, and we are looking forward to seeing the IMF analytical input that the G20 presidency commissioned, and I think we can really deepen that debate and many issues that you mentioned there in our tax symposium in May in Brasilia. So that was really, really fascinating. I'm looking forward also to hearing what Daniel and Natalie think of it, and if our audience has any questions about it. But for now, I will just pass the floor to Jose Troya. As I said, Jose is directly involved in the taxation agenda in the UN. So Jose, please, the floor is yours.
Thank you, Felipe. First of all, thank you for inviting me to this panel. I am very honored to share it with such a distinguishable panelists and audience. I have been invited to this event as I am currently the coordinator of the Subcommittee on Wealth and Solidarity Taxes of the UN. But this intervention is, of course, in my personal capacity, as this is the nature of the membership of the UN Tax Committee. So please let me send me the slides, share you the slides. So, yeah, I'm here to present the work that we have been doing the last 3 years. In 2021, the Committee of Experts established this subcommittee. The mandate is to analyze the advantages and disadvantages of wealth taxation in their different forms and how they interact with other taxes. Identify and consider the tax policy design topics where guidance from the committee is the most useful in this area. Ensure that its work reflects the realities for and the needs of developing countries in various situations and different stages of capacity development, and provides draft guidance on such issues. Actually, it's not more draft guidance, because next slide says that the guidance was approved a month ago in the session of the committee in March this year. This is the work of the subcommittee, which was formed not only by committee members. The work of the UN committee in general builds on work of other stakeholders, in this case governments, for example, from Nigeria, Argentina, and also the committee members that are also government officials, international organizations. I like to see here 2 of the members, Sarah and also Abdul in the audience, which are part of the subcommittee, and also academia. So we developed this guidance, and they were approved, as I said before. More or less, the overview was an introduction and the rationale behind wealth taxes. So we discuss here more or less the topics that were introduced by Alexander. The objective is anyway to give policymakers options, also to raise issues that could be important for decisions. And in a way, if a country decides for whatever reason to introduce this type of taxes, what other issues, for example, administrative issues could be raised. So we have a discussion on the different types of taxes related to wealth. For example, we also here discuss on these 3 types of taxes that could be used or applied. If taxes on the income, capital income in general, also taxes on the transfer of wealth, and taxes on the stock of wealth, and how they could interact, and how the objectives could be achieved, taking into account the three of them, and without prejudice that maybe they could live together, or maybe you can choose one of them if the country decides so. So after that, in chapter 3, we focus in key policy decisions in a general way to introduce this type of taxes, or these 3 types of taxes. For example, how to think about in-scope taxpayers, taxable events, thresholds, and cross-border issues. In chapter 4, we already we go to a specific decision on net wealth taxation for individuals. So we have more in-depth analysis of this type of taxes, but the same topics are also discussed, such as in-scope taxpayers, rates, thresholds, etc. Also, we talk about impact assessment, that is important. So these figures for each country could be different. I am thinking now that, for example, if you have a country with big inequalities, the super rich, the taxation of the super rich would be the taxation of the that would be the aim of wealth taxation, because you don't have other layers. You have, and this is extreme just to illustrate, you may only have super rich and the rest maybe below those thresholds. So that is different in a country that has more equal composition of the population. We also have a specific chapter on if you want to apply this kind of chapter of taxes for exceptional circumstances. I think this is very important, because this is a tool also for countries where they have maybe crisis. It could be not only economic crisis, but also natural disasters, or COVID, or health crisis, and so on. Chapter 6, very important. I think this is going to be very useful for countries to consider what issues, administrative issues, are going to raise if you introduce wealth taxes in your country. And also taking into account that we have a different situation as before, because administrative issues could be a reason why some countries abolished their wealth taxation, but we think that some of those could be overcome with technology and with access to information. And we talk about that. We talk about, in this chapter, about valuation, access to information, compliance, and maybe anti-avoidance measures such as exit taxes. And we have 3 appendices by now. Is Appendix A, a methodology for estimate potential net wealth taxation revenue. Also, Appendix B is legislative elements for this taxation, especially on net wealth of individuals, and a couple of country experiences from Colombia and Norway, which I think are very valuable because they are very different. So you have this also already published in the UN Tax Committee website, and subject to only to editorial changes, this will be hopefully published in the next few months. That is on the guidance that was approved. We have not finished our work, we think, because and this was accepted by the last session in the committee to keep working, but now our work will focus on template or model or draft legislation. It's for countries to consider. Of course, they need to be adapted to their local system, legislative system. So a drafting group was formed, and we presented a structure for this legislation, and we plan to have a first draft in this October, and to the committee to approve this model legislation next year, March 2025. That is not all. I wanted to just to conclude with a few words. I think that sorry, I have something in my notes. So I think that this is very important. So I think this panel is important. Actually, I am glad to share this panel again with Sarah and Alexander. And this shows that countries are concerned about this. Also, to have this type of guidance and also publication and data is very important to introduce this topic in this webinar as well. I think it's not only about domestic resource mobilization, but also on addressing inequality, and in a way also to build trust in the system, because if the top, the wealthiest in the country don't pay enough taxes, they will less trust by the general taxpayers base. So in my point of view, after this work that is continuing, I think that countries could seriously think about introducing this, of course, taking into account their circumstances, and of course, in a flexible way to decide on the rates, on the thresholds, exceptions, etc. And if it is exceptional, for example, or maybe have that design already, and they can turn off the tax for some specific circumstances, and maybe in other circumstances, of course, to reintroduce the tax, and not only in crisis, but also when you have these economic rents, when you have these extraordinary increases in wealth for speculative phenomena, and in financial or non-financial markets, national or international markets. And I think that not always those big increases in wealth are captured by the normal individual income taxation. So in general, the objective is, of course, to have a fairer distribution of that wealth growth, or in some cases reduction in these cases of a crisis. That would be it, and thank you very much.
Thank you so much, Jose. This was really, really useful and very strong words at the end. Yeah, we fully agree. It's not just about revenue mobilization, it's also about inequality. This is a very important point to make. See, if you have questions for Jose, please use our Q&A chat. I will be happy to ask the questions for him after the rest of the panel talks. So our next in line is Sarah. Sarah is, as I said, is head of the Personal and Property Tax Units in the Tax Policy and Statistics Division of the OECD. So Sarah, please, the floor is yours.
Hello, everyone. Can you just confirm that you can see my slides?
Yes, we can see it
Great.
very well. Thank you.
Okay, good. So thank you very much for this invitation. I'm very pleased to be with you today. This is a very important topic. And so I'm happy to be contributing to this discussion. So perhaps as a starting point, I'm just going to re-emphasize something that was mentioned already by Jose and Alex, which is that wealth can be taxed in different ways. We often think about a wealth tax, but there are many ways in which wealth can be taxed. You can tax the income from assets. You can tax transfers of wealth with inheritance and gift taxes. There may be taxes on specific assets, in particular, the property tax on housing. And then, of course, there's the possibility of taxing overall net wealth with net wealth taxes. And so Alex discussed this, and he talked about some of the very important conceptual differences between these different forms of wealth taxation, in particular between taxing wealth stocks and taxing the income from wealth. So I won't get into this, but I just wanted to reemphasize this point to begin with. So at the OECD, we have been doing a lot of work in recent years on wealth and capital income taxation. In fact, if we go back to the previous slide on the different forms of wealth taxation, we've written reports on every form of wealth taxation. So we've released reports on the taxation of household savings, the taxation of inheritances, the taxation of housing, as well as a report on wealth taxes. And those are all fairly comprehensive reports. We also released last year a paper comparing the tax treatment of labor and capital income. And I want to flag as well a paper that will come out very soon, focusing on the taxation of income from closely held businesses and opportunities for tax arbitrage between different forms of income. So we've been very interested in those issues for a while. And I should specify as well that all of this work has been focused on domestic tax policies. So for this presentation, I will try to present some of the main findings or messages from our work on domestic wealth and capital income taxation. And then I'll touch upon some of the cross-border issues in relation to this topic, and I'll focus on tax transparency and the exchange of information. So this is a first, starting with domestic tax policies, and we'll go over the different forms of wealth taxation, starting with the taxation of capital income. So this is a graph from the paper I just mentioned that looks at labor versus capital income taxation. And it shows the difference in combined, meaning both personal and corporate level taxes on wage and dividend income when the tax base is equal to 5 times the average wage. And so in blue on the graph, you have the countries where combined tax rates are higher on wages. And in green, you have the countries where combined tax rates are higher on dividends. And so you see that in a majority of countries, wages are taxed more heavily than dividends. And the fact that capital income is taxed more lightly than labor income in many countries has a number of consequences. It reduces horizontal equity because you have different forms of, you have similar levels of income from different sources that end up being taxed differently. It reduces progressivity. And it also encourages tax arbitrage or income shifting behaviors, which is what we're looking in this paper that is coming out soon. So that's a first key point on the taxation of capital income. Continuing with the taxation of capital income, this is a graph from our report on the taxation of household savings. that was released a few years ago, and it shows marginal effective tax rates between different asset categories, and it shows averages for the 40 countries that are covered in the study. And so what you can see from this is that the taxation of savings is highly heterogeneous across types of assets. And this in itself can lead to distortions in the allocation of savings. It might also encourage some forms of tax planning. So that's a first finding from this. A second point is that you also see some degree of regressivity in the taxation of savings, in the sense that, for instance, bank deposits tend to be taxed more heavily than shares or private pension savings that tend to be held mostly by wealthier households. So what we can see from this is that in many cases, increasing the consistency in the taxation of savings would not only enhance efficiency and reduce distortions, but also enhance equity and progressivity. So that's some key points on capital income taxation. As I said in the introduction, we also released a big report on taxation of inheritances, which again is an important form of wealth taxation. What our report finds in general is that a majority of OECD countries do have these taxes in place, but in general, they tend to raise very little revenue. So this is what this particular graph shows. It shows inheritance, estate, and gift tax revenue as a share of total tax revenue. And on average, across all those countries, those taxes only account for about 0.5% of total tax revenues. And there are only 4 countries where these taxes raise more than 1% of total tax revenues. And those are Japan, France, Belgium, and Korea. And this, as we'll see, is largely, of course, a result of how these taxes have been designed. So this slide shows that there are many assets that benefit from tax relief under existing inheritance or estate taxes, in particular the main residence, family-owned businesses, life insurance policies, but also private pensions. So they either get preferential tax treatment or full exemptions. And there may be cases where preferential tax treatment may be justified, but what it leads to as well is a loss in revenue or limited revenues, which is what we saw in the previous slide, but it also creates distortions and reduces progressivity. And in general, our report on inheritance taxes finds that inheritance taxes can play an important role in terms of reducing inequalities and increasing equality of opportunity, and that they also tend to generate lower efficiency losses than other types of taxes on the wealthy. But these taxes need to be designed well in order to achieve their objectives, and we're seeing that that's not always the case. We have also done work on net wealth taxes with a whole report on this topic that looks at the pros and cons of wealth taxes, the sort of conceptual differences between wealth taxes and other forms of wealth taxation, but also looking at the practical experiences of OECD countries with net wealth taxes. And so what you can see from this graph is that there has been a decline in the number of countries levying wealth taxes in the OECD. And what our report shows as well is that many of these wealth taxes suffered from a number of weaknesses. And a main weakness was, just like with inheritance taxes, the narrowness of wealth taxes, of wealth tax bases, largely because of the preferential tax treatment that was granted to some key assets. So very narrow tax bases was a main weakness, and there were also ample opportunities for tax avoidance and evasion. And so as a result of that, wealth taxes generally raise little revenue, so generally less than 1% of total tax revenue, and were also less progressive in practice than they were initially intended to be. In general, what the report on wealth taxes argues is that countries could consider first reforming their taxes on personal capital income, so taxes on dividends, taxes on gains. We actually are doing work on capital gains at the moment, as well as their taxes on wealth transfers, because we've seen that there's a lot of room for improvement there, before considering a wealth tax. And that's because of some of the practical difficulties of levying a wealth tax, in particular, the regular valuation of assets, but also, as was mentioned by Alex, the fact that wealth taxes are levied irrespective of the actual returns that assets generate. And this has distortive but also unequitable consequences. But we also highlight in the report that country context is important. So, and we say that there's probably a better case for a wealth tax in a country that doesn't have broad-based personal capital income taxes and taxes on wealth transfers. The level of inequality is another important consideration. And very important as well is how a wealth tax would be designed. And indeed, as Alex was mentioning, many of the recent wealth tax proposals are quite different from past wealth taxes in the sense that they target much higher levels of wealth. And so they raise different issues compared to sort of the traditional wealth taxes that were typically levied in European OECD countries. So in general, just our work on domestic tax reforms showed that there's room to enhance the efficiency, equity, and revenue potential of taxes on capital. This would strengthen the progressivity and redistributive impact of tax systems. We've discussed the fact that wealth taxation can be achieved through different instruments, and so there needs to be an assessment of the trade-offs of these different instruments, and these trade-offs may actually vary across countries. It's important to consider the overall tax burden on capital as well, as opposed to looking at these different taxes separately. And very important to keep in mind as well that there's no silver bullet, there's no magic tax instrument that will on its own solve inequality. If countries want to address inequality, they will need to use a combination of tax policies, but also non-tax instruments. I'll go briefly over, so this was on the domestic side of things. Of course, there's an international dimension to taxing wealth. And in fact, in some areas, you need international coordination to ensure that domestic taxation is effective. And the main area is the exchange of information to make sure that offshore wealth doesn't escape taxation. And so I think most of you are familiar with the two global tax transparency standards that the Global Forum on Tax Transparency has developed, and they're monitoring their implementation. So there's the exchange of information on request, which refers to a situation where a tax authority in one jurisdiction is asking for specific information from a tax authority in another jurisdiction in connection with a specific tax inquiry investigation. So that's the exchange of information on request. And then a complementary and more recent standard is the automatic exchange of information, where the idea is quite different. The idea is that jurisdictions that are participating in the automatic exchange of information have to obtain information from their financial institutions on the financial accounts that are held by non-residents, and then they have to exchange that information with the tax authorities of the residence country of these account holders, and they do that automatically in the sense that there's no specific request, but it's done on a yearly basis. And so these two standards have been very critical. And just to give you an idea of the scope of these information exchanges, In 2022, there were more than 130 jurisdictions that reported engaging in the exchange of information on request, and there were close to 27,000 requests for information that were sent to support ongoing tax investigations. In terms of the automatic exchange of information, by 2023, there were 108 jurisdictions that had been exchanging information on an automatic basis on financial accounts held by non-residents. And the scale of the information that's exchanged is really significant. So for 2022, there was information exchanged on over 123 million financial accounts with a total value of 12 trillion euros. And again, this is really essential to ensure that taxpayers are complying with their domestic tax obligations, and it complements the exchange of specific and targeted information requests under the exchange of information on request. And so as a result of that, there have been significant revenue gains. So the estimation is that more than 126 billion euros of additional revenue in tax and interest and penalties have been identified since 2009, of which 41 billion euros have been identified by developing countries. So it's very significant revenue gains, and it keeps increasing. If we take a bit of a forward-looking approach in terms of what are the priorities on sort of global coordination, there needs to be continued progress on international tax transparency. There has been progress already with the crypto asset reporting framework, which is a specific framework for the exchange of information on transactions in crypto assets. There was also a report that was produced for the Indian G20 presidency on enhancing international tax transparency on real estate. And there's continued efforts for effective implementation. So this needs to continue, and perhaps there needs to be further work to identify whether there are any remaining gaps in tax transparency. Another important cross-border challenge in terms of taxing wealth and more generally high net worth individuals is cross-border mobility and a potential risk of increasing personal tax competition. We have seen a rise in preferential personal tax regimes. There is evidence of tax-related migration, in particular among high net worth individuals. And so the question is whether there is a risk of increasing mobility and a risk of potential personal tax competition as well. And then the sort of follow-up question is whether there is a role for international coordination in this space. So that's it for me. Thank you very much.
Thank you very much, Sarah. This was really, really helpful. A lot of very interesting data. You can count on the OECD to present a lot of very good comparative data. Thank you so much. We are mostly on time, so I really want to thank our first three panelists. Now we have Daniel, and Daniel will be not only commenting, but also presenting a little bit about the recent Brazilian experience with taxation. So please, Daniel, the floor is yours.
Thank you, Felipe. Can you see my slides? Are these okay? Yeah. Okay, so good morning, everyone, again. They gave me the pleasure of presenting a little bit of what we're doing in Brazil. I'm serving as director at Secretariat of Tax Reform here in Brazil. I specialize in income tax, and I also work with the VAT initiatives that we are pursuing. So last year, we really created new legislation focusing on capital income of ultra high net worth individuals here in Brazil, both capital income that's earned abroad as well as capital income that's earned within Brazil. Today, I'll share with you our experience from last year. Just to begin with an overview, since I know that we're not all experts in Brazilian tax law, so I think that this is always helpful. So in Brazil, we have your typical dual system with separate taxation of labor and capital income. We have moderate rates on labor of up to 27.5%. That's our maximum rate. And the maximum rate applies to income in excess of 5,000 reais per month, which is roughly $1,000 per month. So it's almost a flat tax here in Brazil, even though we're quite poor and not all of us pay income tax. It's quite a few of us, but really there's no progressivity on the top when we talk about the labor taxation rates. Obviously, tax wedge also considers Social Security, and our Social Security is quite high, and it's not progressive at all. So we really have a problem with progressivity on labor. This is one of our problems. We still haven't focused on that. What we have focused on is on capital income, and in particular, financial income. Financial income, such as interests, gains on securities, gains on shares, traded assets, it's typically taxed at lower rates than labor. We have a very messy system, so we have a bunch of different rates that apply to financial income, all of them lower than the rates applicable to labor income. So we do have a declining rates of 22.5 to 15% on fixed income. There was this thesis 20 years ago that the longer you apply the cash, the lower rate would apply. Based on the individual perspective and asset per asset. I have doubts on that. I would like to hear the colleagues as well on whether any other country has this, but we still have it in Brazil, a declining rate schedule according to the time frame in which the individual keeps his assets in each specific financial asset. Generally, those with higher incomes are able to keep their assets still and enjoy the 15% rate, which is sort of our general standard here in Brazil for financial income. There's a flat 15% rate for variable incomes, including income on the sale of shares in the stock exchange. And like I mentioned, long-term investments as well. And we do have some financial assets that enjoy a 0% income tax rate on a few sectors, such as real estate, agriculture, and infrastructure in general. Brazil, like the other countries, typically taxes its individuals on a cash basis. It does so for labor, it does so for financial assets in general, such as securities and shares held by the individual. We do have a particular feature of our system that when the individual invests through funds, then they're taxed on an accrual basis. So the profit of the fund is automatically taxed twice per year. The fund manager withholds at source the income tax. So it's pretty easy with a very low administrative cost to manage. And people are very used to this already. It's a slight distortion because, you know, when the individual holds securities on its own name, it's taxed on a cash basis. When he or she invests through a fund, he or she is taxed on an accrual basis. So, you know, the market complains a little bit, the market of investment funds, and there is a slight distortion, but at least we're able to tax on an accrual basis the investment fund, and it's a very large piece of our local savings here in Brazil. Until last year, 2023, we had a full tax deferral for profits of offshore companies. We didn't have specific rules for offshore financial income. And we also had a very big loophole in relation to domestic closed-end investment funds, which are basically family-owned investment funds, private investment funds. All of those enjoyed a full tax deferral. And just a little bit more context before I get into what we did. Capital gains have a different rule. Again, 15% as a standard. We have a progressive rate schedule, but only for very high amounts. Dividends, quite particular to Brazil, are also exempt here. On one hand, on the other hand, we have a very high nominal corporate income tax rate of 34% or even 45% for banks and other companies in the financial sector. I'm not going to get into dividends because, we have 10 minutes. Interest on net equity is also something that's quite particular to Brazil. It's a way that companies use in place of dividends. So it's a distribution to the shareholders. The company gets a deduction from its income tax base, and the individual taxes the interest received at 15%. Again, 15%. So interest on net equity gives us a net benefit for the company of 19%. On every $1 that it pays out as interest on net equity, it saves 19 cents in income tax, or 28 cents if you're in the financial sector. So this is something that's very significant in Brazil, has a huge impact on the effective corporate income tax rate. In relation to taxes on property, we do have a few taxes on property at state and municipal level. We have taxes on real estate property. We have a tax on vehicles, which we just included airplanes and boats and jets and that type of thing within the scope of that tax. So we're now taxing not only cars and bikes and motorcycles, but also airplanes and boats. And states also handle a taxation of gifts and inheritance at quite a low rate, but we also approved that it must be progressive in the recent tax reform. And we don't have a net wealth tax in Brazil, even though we have a constitutional provision that would allow us to create one. We never created one in the past. So in terms of the government agenda, what we did in 2023 is we focused on financial income of ultra high net worth individuals. And we started with that. So we proposed in early 2023 new rules for taxation of offshore companies and domestic investment funds. We had a huge debate with the civil society, with the ultra high net individuals themselves, and with their advisors, their lawyers, the banks, and so on and so forth. We also had several discussions with offshore advisors and with Congress, of course. We finally were able to approve the law in the end of last year. It's law 14754, and the law became effective this year, January 2024. In the law, we have two main chapters. The first chapter covers offshore companies, offshore financial income, and offshore trusts, foundations, and all of the trust-like instruments, unit-linked bonds, life insurance, that type of thing. And the second chapter deals with domestic investment funds here in Brazil, and we're basically closing the loophole of the private-held investment funds within families. How did we deal with this? So first of all, speaking about the first chapter, offshores, what we said is, look, if you have an offshore company that's controlled by you individually or with your family, and it either earns passive income in excess of 60% of total income, or it is located in a tax haven, you're going to fall within the scope of the new rules. Okay, so we're using both a passive income criterion as well as a jurisdictional criterion. Very much aligned with OECD recommendations for anti-tax deferral rules for CFCs. The general tax regime is the profits of the offshore companies are taxed on an accrual basis here in Brazil. So the offshore company is required to provide us with a balance sheet. In the balance sheet, it will appoint its profits. Its profits are typically calculated according to, always calculated according to IFRS, which is also our standard here in Brazil, in which generally we have mark-to-market of financial assets, such as securities and shares, tradable in a stock exchange. So on December 31st of every year, you have a balance sheet, you have a profit of the offshore company. Those profits are basically the difference from its bank account, from one year to the previous year. Banks also typically mark to market these financial assets in the documentation. And once the profits are taxed, they will no longer be taxed upon distribution. So we don't have the lock-in effect anymore. Previously, since you had the full tax deferral, the immediate consequence is this lock-in effect. So people don't want to move their cash, around the globe in order to avoid taxes. So just funny story. We have a group of like 300 ladies or so from our society here who looked for advice from a lawyer who's a friend of mine, and they were super happy with the new rules because they can pay now with a reduced rate, and they can use their cash and whatever they want. When we have widows, and old ladies who want to use the cash and who were very much afraid of touching the cash because of the history behind offshore companies, undisclosed amounts, and so on and so forth. Just one more piece of information. In 2016, we had a window in which people could disclose assets which were previously undisclosed. So they paid a 30% tax, and they were able to have full transparency, and disclose these assets to the authorities. We did that in 2016, and people kept those assets at cost in their income tax returns. They were afraid of moving them. Now with the new rules, the government is saying, look, if you pay the tax, you can move the cash, you can do whatever you want. You can buy a house, you can donate to your children, to your grandchildren, and so on and so forth. And people, at the end of the day, some people are appreciating the fact that this was created. During the public debate, there was concern raised in relation to the concept of realization of income. We know that this is commonly discussed worldwide. In Brazil, we have a sort of a legal culture which is quite adherent to this concept of realization of income as a precondition of taxation. It's not unanimous in the scholarly literature here, but it is quite predominant. So we gave them a solution to opt in for a full transparency of their offshore companies. So, okay, guys, you don't want to have taxation on an accrual basis of the profits. Okay, then you go for full transparency. We're going to completely ignore the existence of the offshore company for income tax purposes, and the underlying assets and liabilities of the offshore companies will be disclosed as if they were owned directly by the individual. In that case, you move from the accrual basis to the cash basis, asset per asset, and we also allowed the offset of gains and losses, properly disclosed, of course, with banks outside Brazil. So this was a solution to solve the whole discussion on, oh, you're taxing mark-to-market of assets, you're taxing unrealized income, and so on and so forth. And we're also enabling people to choose to opt in for this regime for each of their offshore companies. So if the guy has these very sophisticated fellows who have, venture capital, private equity, together with liquid assets, they're happy to split their assets in two companies, keep the general regime for one and choose the optional regime for the other one. And we also said that this regime is once and for all. So you opt in and that's it. You can no longer, flip the switch to opt in and opt out. It's easier from an administrative burden perspective. In the case of foreign trusts, it's a huge challenge for governments, of course, how to deal with foreign trusts. You have a foreign trustee, you have foreign assets, and you have your residents either as a settler or as beneficiaries of that trust. The way we went about it, we created a full transparency, just full transparency for the trust. We completely ignore its existence, and we say that these assets and the income are owned either by the settlor or by the beneficiaries. They cannot be sort of in a limbo in a third place, in which no one declares these. So it's either settler or beneficiaries. And in the law, we also impose obligations for the foreign trustees to provide the necessary information and resources to enable the settler or the beneficiary to comply with his or her tax obligations here in Brazil. Let's see how this is implemented in practice. We're going to monitor it. In terms of rates, like I mentioned before, we have rates in Brazil that are relatively moderate compared to the rest of the world. We proposed a separate schedule for taxation of financial income, going from 0 to 22.5%, so slightly below labor income but not that much below. At Congress, they moved to a flat 15% rate. They prefer that, like I mentioned, that's the general rule for financial income in Brazil, and we're still not dealing with that. So that was okay. And very much important in the discussions, obviously, we had the risk of people leaving Brazil. Mobility of people is something that people do here in Brazil. Especially ultra high net worth individuals, we have very popular options. We have a bunch of Brazilians moving to Portugal, to Switzerland, to the UK, to Italy, and so on, and so to Uruguay, and so on and so forth. We have several friendly jurisdictions that receive millionaires and billionaires from Brazil. So we were always afraid that this would happen. So having a flat 15% rate also made the rules more amicable to the taxpayers and reduces the risk of people leaving Brazil, people mobility. The optionality and the other stuff that we did also took into consideration this risk and its mitigation. So we also closed the loophole for domestic investment funds. Investment funds are very popular in Brazil, both in the market in general as well as with ultra high net worth individuals. Like I mentioned before, open-ended funds, which are market funds, have been taxed on an accrual basis since the early 2000s here in Brazil. But closed-end funds, family-owned funds, enjoy the full tax deferral until 2023, and they are now taxed as well on an accrual basis as of January 1st, 2024. There are still options for ultra high net worth individuals to shift to a cash basis of taxation. Like I mentioned, if he or she holds securities directly under his name or owns shares directly by the individual or through funds that are specific for shares. So there are still options for the folks to move to a cash basis of taxation. Again, we created an accrual basis of taxation. Some people will remain in it and pay taxes on an accrual basis, but other people may prefer to move to these other ways of investing, which are taxed on a cash basis. We're seeing a lot of movement now because we just created these rules and we created a transitional regime in which we allowed people to pay a lower rate when they transition from the old tax regime to the new tax regime. And now we have a bunch of money that's going to be reorganized in the market. So we're monitoring that as well. We have worked on other initiatives. Like Sarah said, there's a bunch of things, Sarah, Alexandra, and Jose as well. There are a bunch of things that we can do to reduce distortions in the market and seek both more equitable ways of taxation as well as more efficient ways of taxation. So we did 3 things in Brazil, in addition to what I just said. So we have these 0% financial assets in the real estate and agricultural sectors. We created harsher regulatory standards for companies to issue these financial instruments, these bonds. We had a bunch of companies that were outside of these sectors issuing these bonds. So we were able to focus the tax benefit on the sectors. This has a huge impact on the market because you don't have these huge players from the financial industry, other industries competing with real estate and agriculture anymore. So it's good for everyone. It really improves the market, the way the market operates. We blocked the creation of a new privately held fund that people were beginning to do under the umbrella of private pension funds. So people were creating private pension funds of their own with a full tax deferral, which could create risks for private pensions in Brazil. So we worked on that together with our colleagues from the regulatory, the private pension funds regulation, SUSEP. And we also created a new set of rules for infrastructure debentures, which are also 0% taxed. We're trying to move the tax benefit from the personal income tax level to the corporate income tax level, so that we don't create sort of pools of cash that these companies can access differently. So before, when you have a 0% tax for individuals only, companies basically issued these bonds only for individuals, and they were not able to access the pockets of pension funds or institutional investors. Once you move the tax benefit to the corporate level, you are potentially going to be able to pay a higher interest rate, the company, but also accessing the pools of cash of the institutional investors. And the government wants to incentivize these infrastructure debentures. And in the regulations, we also took into consideration the environmental impacts of the sectors. So, for example, we left oil out of the regulations. We left other green-friendly sectors within the regulations for the incentivized debentures. In figures, so we have stocks of offshore companies of around $200 billion, which is a huge amount for Brazil. And we have stocks of closed-ended investment funds of around $100 billion, which is also very much for Brazil. Like I mentioned, we created these specific transition rules to move from the old regime to the new regime. We proposed a reduced rate of 10% for folks, and Congress reduced it to 8%. In Brazil, everyone paid in relation to domestic investment funds. So we're raising tax revenue of around $4 billion. It's $4 billion because part of the stocks relate to the principal amount that people injected in the funds, people restructured, and so on and so forth. But it's for around $4 billion that we are raising in the case of domestic funds. In the case of offshore companies, we still haven't raised the cash because May is our deadline next month. We're still, issuing regulations. It's an electronic program that people will file in order to pay the tax. Perhaps we can, raise something similar, but we need to wait and see because there are a lot of variables there. It's very difficult to have an estimate. And these regulatory measures that I was speaking about also have a very positive impact on revenue in addition to equity and efficiency, because we're basically focusing the tax incentives on specific sectors, which both incentivize these sectors that the government wants to incentivize, as well as pushes the other sectors to these general ways of funding in the capital market and just paying regular tax. So it's also going to have a positive impact on revenue. We're not putting a tag on that, a value tag on that, but we also expect it to raise a few billion dollars due to the restructure of the market. Okay, so that was a very quick summary of what we did in Brazil in 2023, what we're doing now in 2024. I'd like to thank everyone. Obviously, this presentation is in my own capacity as well, but it is very much factual, so it's hopefully it's interesting, and we expect to publish this soon as well. Thank you.
Thank you, Daniel. I think this national perspective really gives value to our panel. We've been discussing aspects of wealth taxation, and it's good to see what one specific country is doing. Okay, so now we have Nathalie to comment on the presentations. Nathalie, please, floor is yours.
Thank you, Felipe. First of all, I would like to thank IPEA and BRICS Policy Center. I used to work at IPEA some years before, so I really feel at home here. I would like also to thank Daniel and Jose and Alexander and Sarah. I learned a lot today. So I'm not a specialist, I'm talking in a civil society perspective. I belong to some civil society networks at national level and at international level that are discussing wealth tax, mostly in a sense of justice. So I have, listening to you, I have 4 comments. The first one, I think we all agree. That's so funny because I never used to agree with IMF or OCDE, and here I am today in this panel agreeing with IMF and OCDE. So yes, inequality is rising, and with inequality, hunger and misery and global warming are also coming. So problems are rising. So we need more resources to face those problems, and it's natural that the ones that don't pay their fair share should contribute, and that's why a wealth tax makes all sense. And we all know that Progressive tax systems are important for social coherence and are also important for financing public goods that are important for growth. So yes, wealth tax is important, and we all agree here. And it's not only because inequality is rising, it's because it's rising in an absurd way. The recent Oxfam report that shows that the 5 richest men in the world doubled their wealth since 2020, since 5 billion poor people were made poorest. So it's a huge problem, and it's threatening our democracies. So this was the first comment. We all agree a wealth tax is necessary. The second one is that as it is a transborder issue, we heard Daniel now, and we also heard what Alexander and Sarah told us. It must be addressed multilaterally. And we believe that the right space to discuss that is the UN. Felipe said earlier that we have an urgency. That's why the OCDE is important. But the question is on who is going to pay this urgency bill, because the way it is being negotiated nowadays doesn't attend the poorest countries and the poorest populations. So we really believe that the right space to discuss these issues is the UN, and specifically the United Nations Framework Convention on International Tax Cooperation. So we are fighting that this body is strengthened, and we really hope that the G20 is going to push for that because of justice issues. The third comment is that we believe that stock must be redistributed. I don't know what is the best way to do the wealth tax, to agree on a wealth tax, but it must be redistributed. So assets, shares, and everything must be redistributed. We cannot have a bunch of people in the world that have all these assets, and this must come back to people and to the economy. So a wealth tax should be able to allow this redistribution. That's why maybe it's important for states to be able to tax accepting assets and not only cash, as Daniel said, I believe. And my last comment has to do with is not a cure of all, because suddenly everything will be a solution with the wealth tax. So, okay, it's an important measure. We will enforce it, but other measures at national level and international level should continue. As Sarah told us, the exchange information is so important for those kind of measure. But we need to continue to tax property. We need to continue to tax incomes. We need to continue to tax inheritance and etc. So I'm a little bit afraid of this, now everything has to do with wealth tax and we forget all the rest. And no, we really need to enforce progressive tax systems, and with all the bunch of measures that are needed for that. So that's what I would comment now. And thank you all for all this. I've learned a lot. And thank you.
Thank you so much, Natalie. This was short but very powerful, very, very important political points to make. Okay, so now we have 34 minutes for Q&A. We have a couple of questions already. Let me strongly encourage people watching us on YouTube or on different channels to post their questions. And I will give you 5 minutes to post additional questions. And meanwhile, let me give you a very quick update on what Brazil is doing in the G20 presidency regarding international taxation. So we, as I said right in the beginning, this is a topic that really has a lot of political priority for us. This priority comes directly from our finance minister. Minister Fernando Haddad really places a lot of emphasis on fair, redistributive taxation, both internally and externally. So we are really following this high political mandate, and this also comes from a political mandate from President Lula. President Lula named as the first priority of the Brazilian G20 presidency the fight against hunger and poverty. And to effectively fight hunger and poverty and achieve SDGs 1 and 2, we need new sources of financing. And international forms of taxation are really, really top of the list there on where we are going to find the resources to achieve SDGs 1 and 2. So starting from this very high political priority, we are devising a very ambitious program to talk about forms of international taxation and revamp international taxation cooperation. We had a session in the meeting of finance ministers in February exactly about it. And we will hold a tax symposium in May in Brasilia, where we'll have the chance to hear a lot of inputs from organizations, and the IMF, the UN, the OECD will all be invited, and we're really looking forward to your contributions there. And then after the symposium in May, we will be in a position to propose an international taxation declaration. So we will work together with other G20 countries to create a very short document that will aim to give political impulse to the international taxation agenda in the OECD, in the UN, in other forums, and promote fair taxation, especially focusing on the super rich. So I think my first question to the panel would be related to that. I know you are all technical experts and you are very focused on your specific research, but I would really like to invite you to take the hat of the policymakers and people making the political decisions and think about what would you like to see in the international taxation declaration by G20 ministers. That would be very, very useful to hear. We are hearing from different countries, we are hearing from different experts, and I really would like to hear Alexander, Sarah, Jose, Daniel, what should we put there in the declaration? And keep in mind that this will be a short document, right? So we are not going to very technical details. We are really placing the big topics there in the agenda. So what can't be missed? And with this first question, I will return to the panel, and then I will take the questions from the audience. So let's answer that in the order of the panel, starting with Alexander, and then Jose, Sarah, and Daniel. Alexander, please, floor is yours. And of course, you can comment on anything else you heard in the panel as well.
Yeah, thanks very much, Felipe. And of course, you started off with a really challenging first question. Let me stress maybe the side of what can countries do to tax super rich people. I think in my presentation, and Sarah also mentioned it, it's the difference in different capital incomes, how they are taxed, the under taxation of certain capital incomes, especially capital gains. Now, first, let me stress there is a lot that countries can do. If we look at super rich people now in the world and their very low effective tax rates, a lot of this can be enforced by the countries themselves, especially by some of the really rich countries that have all of the means to enforce the system. It's really the only thing holding them up is a political constraint. It's not a technical impossibility of taxing this. And in that regard, I really appreciated Daniel's presentation about what Brazil is doing to go after unrealized capital gains. It should inspire everybody. But then it brings me to the other point, which also Sarah mentioned a lot in her presentation, which is the international cooperation on the administrative measures, extending exchange of information. This is really what you need to do to go after income that is hidden or that is in some non-transparent sources. And of course, the more of those we close, the more new ones will be found by people really trying to avoid and evade taxes. So over time, also the cooperation has to become more sophisticated to close down any new loopholes that emerge. And with that, I'll stop for now. Thank you.
Okay, thank you so much, Alexander. So let's have now Jose. Jose, please.
Thank you. And I'm risking of being repetitive, but I just wrote down what some of what Alexander said. I think that if you are talking about these international organizations like the G20 and other ones that may be ahead in policy options, I would address more international cooperation. I think that even if countries can have very good internal laws and very well designed and have the right balance that is difficult to find in their internal laws, it won't work if you don't have information. So if we are addressing wealth of the residents of a country, you know that though they will be part in your country, but most of it or much of it abroad. So I think that you need to speed up the process for maybe new standards, new ways of exchanging information, not only focusing on financial assets, for example, but also on real estate and other type of asset holdings. And improving also the exchange of information on request mechanisms. And also something that we is our task in the UN, also in a different subcommittee, is on cooperation in tax collection, which is something that is in the, we have that in the multilateral convention and also in some of the double taxation agreements, but countries have not used it enough, I think, and developing countries need to address that issue as well. Thank you.
Thank you so much, Jose. Great ideas there. Sarah, please.
Yes, so I'm going to repeat, I think, part of what was said. And I'm really speaking in my personal capacity, not as really representing the OECD's views on this difficult question. But I think I would recognize that indeed taxation is a key instrument for governments that want to address inequality. I think that's key. That it needs to be done in conjunction with other policy tools is also an important message. I think the various presentations show that there is a lot that countries can do domestically to enhance the role of tax systems in addressing inequality, in particular through more effective capital taxation. So lots of room for domestic action, and there's no one-size-fits-all approach, most likely, in terms of, I mean, there can be useful guidance on certain taxes and how to design them and learning from other countries, but there's no one-size-fits-all, and there's always assessing trade-offs, and these trade-offs may be different for developed, emerging, or developing countries, so that's an important message as well. But as much as there's room for domestic action, there is a need for international cooperation. Without that, domestic taxation risks being ineffective, which is why the exchange of information was put in place, was to make sure that countries actually were able to tax offshore wealth. And so as Jose and Alex pointed out, there's probably room there to see whether, first of all, to continue ensuring the effective implementation of the exchange of information, that's absolutely critical, and to see whether there might be some areas where the rules should be strengthened themselves. And I think another important message is that on other cross-border issues, and in particular this issue of mobility of high net worth individuals, I would say that a message could be that there needs to be further analysis on this issue. I think this is something that we hear about a lot, and some have already proposed solutions to that, but I think a first step may be to better understand what are the issues in terms of cross-border mobility. So those would be some of my messages. Thanks.
Thank you so much, Sarah. Indeed, the exchange of information, I think, is something that we have to emphasize more. I think this is really a point we're taking note here. Daniel?
It's quite the spotlight that you're putting me in here, Felipe. Like you said, I am a technical expert. I'm not a political guy. So I can speak on my own capacity as a student of these matters for several years now. I would say that the exchange of information, CRS and FATCA, changed everything in this scenario, changed everything. It was revolutionary. It's a must-have. So I'd say that this is the most important assumption that we can have. in terms of international cooperation. Without that, we would be back, in the old days of undisclosed wealth, undisclosed income, and impossibility of taxation, and huge risks of capital mobility, not only people mobility. So that's number one for sure. From a technical perspective, I very much appreciated this latest paper from Alexander Clem and the IMF, and the words that Clem gave us today. We have three ways of doing it, return on wealth, wealth stocks, and/or transfers of wealth. The way that we did it in Brazil was based on the return on wealth, so capital income. It's tangible, you can see it, it's in the bank account. It's something that people, or mark to market of shares and securities. I mean, this is something that you can tangibilize, that you can see. So I think that this is an opportunity that we should focus on. And the way that we did it in Brazil was enabling full transparency, either accrual basis and taxation altogether, or full transparency and cash basis, with a very moderate rate of 15%. Which, by the way, by coincidence, is also the rate that Pillar 2 applies for multinational enterprises. But I would say that this is a possible rate. And why not have a Pillar 3 for ultra high net worth individuals based on their capital income at 15%, fully transparent worldwide, just thinking out loud here with you guys. Obviously, taxing stocks of wealth is much harder to do. It's harder to measure. It's, I would say, politically more difficult as well, because you have the once you talk about taxing wealth, people raise their eyebrows, and they're very much afraid, when you talk to these ultra high net worth individuals. So I would say that taxing capital income is easier than taxing the stock of the wealth. And in terms of transfers of wealth, I would say that it's not much on an international cooperation perspective, but more unilateral. I really don't see any technical support for enabling the transfers of wealth above a certain threshold at cost basis. I think that we could tax unrealized gains upon the transfer through a gift or through inheritance. That's something that countries can do. I'm not even talking about the US loophole about the stepping in basis upon death. I'm not even talking about that, that definitely doesn't have a technical grounds in my personal perspective, but also in other inheritances and gifts above a certain threshold, like $10 million or $20 million, in which people can't argue that they don't have the liquidity to pay the tax. This is something that could be done, but more unilaterally than in terms of international cooperation. And finally, I would definitely say that the mobility of people is something that we should all be concerned with. Ultra high net worth individuals are very mobile. They don't need to live in Brazil. They can live anywhere, and nowhere as well. This is something that's interesting. People can live nowhere. And since the income is earned based on capital and wealth, there's really no immediate link to Brazil other than cultural, family, and personal links, but economically wise, they can live anywhere. So if people can move around without paying their taxes on their wealth, it's quite easy. So definitely this is something that we need to examine on an international cooperation level. And I think that Mr. Haddad has very importantly taken that to the G20 arena. So Felipe, I think these are my messages. But again, I'm just a technical guy, I'm not a political guy, and so you need to have the proper adaptations to my words, please.
Thank you so much, Daniel. We really take note of that. Of course, we are taking note that all of you are speaking from personal capacities, and this is, it's a high political debate, but we really benefit from your technical input there. Natalie, civil society will have the chance to directly contribute to the declaration. We are asking the civil society organizations to give us some direct inputs, but if you want to say anything to the matter, if you want to contribute to the discussion, please.
Yes, for sure. I think that what Brazil is doing is really interesting. For the first time, the financial track is listening to civil society. at least at global level. And this is not only, as you all said, this is not only a technical debate, this is also a political debate. I know Daniel said that he's not a political, but yes, you are. Since you're working in the Ministry of Finance to build laws that the Congress will approve, you are doing policy. I think that the most affected by this inequality and by this inequality coming with hunger and poverty and misery must be heard, and even learn from the technical side what is the best for the majority. So I really hope that Brazil is going to take this G20 initiative to the other G20's presidency. Thank you, Felipe.
Thank you so much, Nathalie.
Nathalie, I'm just not skilled in politics.
Yes, you are. Yes, you are. Yes, believe in you.
Okay, guys. So now we have 4 specific questions for our panelists, and we have 15 minutes to go. So we'll ask each one of them to just use 1 or 2 minutes to answer their specific questions. And if the rest of the panel wants to make a very quick comment, we can also accommodate that. So starting with Alexander, I'm reading here from the chat. Do you think the best way to tax high-income tax individuals is not by country of residence, but by their citizenship, as occurs in few countries as US? Citizenship is less mobile than residence.
Yeah, thank you. This is another great and difficult question to answer. So I think it certainly is a topic that is worth thinking about. Let me talk about a couple of aspects. So one is, ultimately, it's not a bad thing that people can move around the world from one country to another, right? It's good for all of us that we don't all stick in our home countries. So we don't want people to do this just to save taxes, of course. But if somebody really moves their center of life, pays taxes elsewhere, and enjoys public services elsewhere, we should also not prevent that. So some countries have some interesting middle ground solutions. So they say, if you move to a somehow defined low tax jurisdiction, we will keep taxing you for 4 more years. So that's one thing you can think about doing. Another thing some countries do is that, well, if you leave, you have to pay an exit tax, meaning that all of the capital gains you have accumulated until the day you leave, you now have to pay tax on them, maybe something also on your pension rights you accrued. You can think about it. So there are many things you can do without moving to full citizenship-based taxation, which raises some complications. When people have multiple citizenships, they will have to file all sorts of tax returns. And finally, also, not every citizenship is equally valuable, I would guess. So while it is really powerful, the risk of losing nationality of an attractive country where you actually want to live, losing nationality may not really prevent people from moving if their own country doesn't offer great economic opportunities. So by forcing them to choose, you're actually forcing them, rich people, to give up the nationalities. So these are the things to think about, and this is what I want to raise rather than giving you a straight yes or no answer.
Yes, great considerations there. A very, very interesting topic. Does anyone else in the panel want to quickly comment? I can give you 1 minute. No? Okay, so let's move to a specific question for Sarah. And again, I'm reading from the chat here. Sarah, does the OECD study multilateral coordinated proposals to tax high-income individuals, as has occurred with corporate income? The automatic exchange of information has great potential to tackle these individuals. Yeah?
So on the question of whether we're exploring a global coordinated solution, the way we have, basically, do we have a form of P2 for individuals plan? The answer is no. This is not something that we're looking into at the moment. What I can say is that there is interest in looking at some of the cross-border issues raised by personal taxation beyond what we're currently doing on the exchange of information, I think there's interest in particular doing some analytical work on those issues. So if the question is about whether we have a plan that we're working on at the moment on a form of Pillar 2 for individuals, the answer is no. But we're interested in this question of taxing individuals, and we recognize that there are cross-border challenges. We're working on the tax transparency one, but there may be others, and we're willing to look into some of those challenges, in particular if countries are also view this as a priority.
Thank you so much, Sarah. And she also mentioned earlier, she talked a great deal about automatic exchange of information, which is really like rightfully recognized as a major step forward in international taxation cooperation, and the OECD played a big role in that. So yeah, our recognition of that. So for Jose, I'm reading here from the chat, the UN report intend to be published next year will contain a multilateral purpose to tax the super rich that is avoiding taxes. So I'm not sure if the question is very clear. I will repeat the way it is written here and you will interpret it. The UN report intend to be published next year will contain a multilateral propose to tax the super rich that is avoiding taxes.
Yeah, I think I understand, and I think to separate the work of the UN Tax Committee, which I am a member of, and this new initiative of the UN framework. So that is only taking shape now, and countries, because it's a governmental body, countries are meeting and negotiating that, and we don't know what are going to be the main issues. And wealth taxation, a coordinated wealth taxation could be one, but it is open. In the committee, we are working on guidance for countries for internal law, specifically for internal law. We talk in the guidance on, we have the issue there on international cooperation, for example, these issues that we have talked about, the exchange of information and so on. But it's more focused on a legal, internal legal framework. And it will be published soon. Yeah, I would like to add maybe something that is maybe a remark on earlier interventions. On I think that we can have this pillar 3. We can talk about that. I think that we don't need to duplicate work, so it could be an initiative by the UN or the OECD. But as the introductory remarks made by you, maybe we have some urgency, and I don't think that these type of multilateral solutions could be solved in the short run. So we need maybe the same as these digital taxes. We need countries to have these tools as well, and I think that is the value added on this guidance. And also looking in the long run, hopefully we have something like that, because the cross-border issues are going to be there. I think there is a parallel, of course, with what is already for many years discussed for corporate taxation. And one of the issues, these mobility issues, I would like to raise as well, not only having exit taxes or other tools, but also addressing maybe with cooperation these golden visas. I think that we need to develop more, and as I said before, maybe even standards as we have with harmful competition, harmful tax competition, on this type of harmful tax competitions for individual taxations on individuals. Thank you.
Thank you so much, Jose. And now a question for Danielle. And I'm again reading from the chat. Is the government planning to publish statistics on CRS matching, the level of compliance, etc.? it would be really important for researchers and civil society to understand what the government is doing with this new trove of data, and also better understanding the scale and nature of offshore wealth. Is it clear, Daniel?
Yeah.
Shall we read again?
Yes, no, it's clear. It's clear.
Okay.
Like I said, I think that CRS and FATCA were game-changing measures, for sure. In Brazil, we always had reporting obligations, not only on income, but also on the assets held abroad. And we have reporting obligations for the Brazilian Central Bank and for the Brazilian IRS, right, for a revenue service. So we do have information and data, including the data that led us to measuring the stock under these offshore companies. We know the activity of the offshore companies, those that are dedicated to financial income. We have a bunch of data in that respect, sitting at the central bank and the revenue service, and there's a lot of interaction between the two as well. I am personally not from the central bank and not from the revenue service. I am from a different secretariat. I would have to speak to my colleagues to see if we can publish statistics, excuse me, on an aggregate level, obviously protecting secrecy and so on and so forth, of individuals, not disclosing identities, that type of thing. Just to respond, I don't know yet if we're going to be able to publish the data, but I will gladly speak to my colleagues to see if we can do so. I have also been provoked by my friend Pedro from IPEA, who invited me to the panel, that we should publish what we've been doing here in Brazil in 2023 and 2024. Hopefully that may be useful to other countries as well. So we're also going to work on that. Thank you, Felipe.
That's very good, Daniel. Thank you so much. And I really want to encourage you to do that, because the work, on tax reform in Brazil is really, really amazing. You really get our recognition. Okay, so there's the final question for me. And I'm reading here: does Brazil plan to promote its idea of a global minimum wealth tax through the UN tax convention? That's also a bit of a tricky question, because those are ongoing negotiations, and I shouldn't be commenting on ongoing negotiations for obvious reasons. I'm also a career diplomat, and we know that if we talk about what is going on within the rooms we are negotiating, things don't happen. But what I can tell you is that there is a high level of complementarity, of coherence between the Brazilian public agenda in the G20 and what we are proposing in the UN and between negotiations, right? So I cannot give you much details there, but I can say that we are walking the walk. We are talking the talk and walking the walk. So this is what I can assure you. Okay, so we have 5 minutes for final comments. If the panel has any final comments, I will ask the panel one by one. Just say final words. My final words would be that this has been an amazing panel. I learned a lot, and I really thank Alexander, Jose, Sarah, Danielle, Natalie for being here. This has been recorded and has been shown on YouTube, and hopefully this will be helpful for many people. So thank you again so much for being here. Thank you, IPEA. Thank you, the BRICS Policy Center, for organizing it. And Alexander, your final words, please.
Yeah, I think on policy, I've said everything. So let me also just conclude by thanking you very much for having me here. It was great to discuss, and I look forward to continuing the dialogue.
Thank you, Daniel. Jose?
Yes, also thank you, Pedro, the organizer, the BRICS and IPEA, and maybe just us discussing this I think is good news. Thank you.
Thank you, Jose. Sarah?
Yes, just final words from me are also just thank you to everyone. This has been very interesting, and just like Jose and Alex, I think this is great that we've been able to discuss this together, and I look forward to discussing this further with you. Thanks very much.
Danielle?
One complaint, Felipe, too short. So I think that we would need a few days, at least a few days, to discuss all of the things that we talked about today. But it was very interesting Even though it was short, it was very condensed, a lot of good information here. And I would welcome the audience to look at the papers that our colleagues from the IMF, the UN, and the OECD have published. They have been super references in my work as well. So thanks, everyone, and hopefully let's continue the dialogue.
Thank you, Daniel. Nathalie, final words?
Yes, thank you very much for the invitation. And I would like to congratulate the Brazilian government to allow civil society to be part of these debates. This is really, really important. Thank you. Thank you to all.
Okay, thank you, everyone. So our panel ends here, and thank you for watching.
Bye.